For more on the road ahead for the U.S. economy, let's join Peter Churchhouse, who's Advisory Director at Morgan Stanley, and he's live in our Hong Kong studio. Peter, it's long been a slight point of contention amongst economists as to whether Alan Greenspan's analysis of the economy is the correct one or whether the bond market is correct, because the bond market has been saying interest rates are heading higher, and Alan Greenspan has promised there will be no interest rate hikes for the foreseeable future. Now we get Jon Snow jumping into the fray and saying that interest rates are heading up soon and the economy, which was previously a coiled spring, has now sprung, he says. It all seems somewhat confusing. What do you think the message is here?
Well, I think, quite frankly, the third quarter was extremely strong, as you've just mentioned. Some economists are talking 7% annualized rate of growth, which is very, very powerful indeed. I think the sustainability of that pace of growth is very, very much in question. And I think from that point of view, I think Alan Greenspan is not convinced that that pace of growth can be continued. And I think he's suggesting that this has so far been a pretty jobless recovery. We don't see any really signs of inflationary pressure picking up. So I think he's sitting back and reserving judgment on interest rates until he sees these signs of inflation and jobs picking up coming through. And so I think he's going to sit and wait for that.
The thing you have to question, though, is why the Treasury Secretary would come out so explicitly contradicting the Chairman of the Federal Reserve. Politically, that seems like a blunder.
Well, I'm not sure it is really. If you think about it, he's really part of the Bush administration. Greenspan is supposed to be an independent banker. So there is really that independence. And I think Jon Snow perhaps is making a political point here for the Bush campaign that, listen, fellas, we've actually got your economy turned around. We've done all the right things. And in fact, we think it is sustainable. And this is good news. And our administration has done this for you. I think that's the kind of message they're trying to deliver, and saying, well, yes, a rise in interest rates is good news because that tells us that the economy is on recovery path. So I think it's very much a political gesture more than really an economic gesture at this stage.
There is a history, not too far back in the recent past, where the administration tends to say one thing and then end up sticking its foot in its mouth when it comes to economic effect and cause. You know, the last bastion of the U.S. economy, the consumer, they're spending on cars, they're spending on homes, refis, first-time home buyers. This kind of talk is obviously going to have something of a negative effect in the market as this week progresses, isn't it?
Well, I sense, quite frankly, the consumer, as you say, has been extremely powerful in this rally, and is now actually consumer durables actually accounted for something like about just over 2% of GDP growth. This is typically normally about just under 1.5%. So this is very, very powerful indeed. And I suspect that much of this durable goods consumption may well have been borrowed from future consumption rather than be the result of pent-up demand. So I think there's a likelihood here of an economic backtrack in the fourth quarter more than a sustaining of the pace that we've seen. So I sense here we could see some minor shocks to the downside rather than the upside over the balance of this year as far as some of the economic numbers in the US are concerned.
Interesting, Peter. I mean, you for the longest time have been quite bullish on the state of the U.S. economy. So what exactly do you see the picture as being for next year now, then, if you don't think this is sustainable? What's going to derail the growth that we've seen thus far?
Well, quite frankly, it's just the pace of growth. I'm still convinced we're going to see something in the region of 4% economic growth next year. But this last quarter has been way more powerful than anybody expected. And I think markets have actually embraced that with the sense, really, that we're discounting that continuing into the future at 6 to 7% annualized economic growth. I think the market is perhaps is going to end up being disappointed if we look like we're swinging back to what is a more reasonable rate of annualized growth in the 3.5 to 4% level. So I think the pace of consumer durable spending in particular, that has to slow down. We've always seen it slow down from when it's 2% of GDP. That's too high. It'll swing back to 1.5% over the course of the next couple of quarters. And that means I think you could get corporate profit shocks to the downside coming into the first half of next year.
What is the what is the at least the midterm outlook for the market? Because the reality is there's been so much optimism that's been priced into the market. If you look at the S&P 500, I mean, right now it's priced at a multiple which is running about twice the clip of the historical average. So clearly, to many, things are overextended. I mean, would you feel more comfortable about the longevity of any kind of economic recovery in the United States if prices did come off a little bit and a little more rational exuberance came to the forefront?
Well, quite frankly, I think in the very short term, I think the market's likely to be held up quite nicely. We've got so much liquidity in the system. We are seeing quite good numbers coming through in the short term on earnings, and we're seeing CapEx picking up and so on. So I think there's a likelihood that the market will be quite well supported over the course of the next few weeks. But I do think that as we come into the end of the year and perhaps into the first part of next year, I think a lot of fund managers are going to take a little bit of profit off the table before year-end, lock in their numbers for the year-end, and I think you could see a little bit of a drift downwards. But I'm not expecting any major crash here unless we see a major fallout and say something like the US dollar and the US dollar collapses. That would be a very, very negative sign indeed. But I don't think we're forecasting that. We're looking to see a gradual easing of the dollar, and that in fact, if it continues on that path, may actually be quite positive for the market anyway.
Let's get on to the dollar in a short while, Peter, but just before we go to the break, let's just wrap up this particular US portion of the chat with a look at the year ahead, because as you mentioned, Jon Snow is talking a political line here with presumably one eye to the elections which come up in about a year from now. And of course, the administration is going to be doing its darndest to get the economy looking good ahead of that election. The question is, if you're predicting that this economic movement might run out of steam, he's going to be in some trouble, isn't he? The tax cuts that we put in came in pretty quickly, and it's given this third quarter the big boost, maybe a little quicker than he expected. What remains then in the armory for the Fed, for the Treasury, for the President, in order to be able to maintain this for the next 12 months before the people go to the polls?
Well, that's a very, very good point, of course, because they've just about shot most of their bullets here. There's nothing much else that they can do. Of course, they can continue to print money and with fiscal injections and so on, run the deficit deeper. We've seen that in the past for sure. So we could see some sort of fiscal continuation of the fiscal policies we've seen in the last few months if it looks like the recovery is running out of steam perhaps in the first quarter of next year. But having said that, though, I think if we see an administration looking at around a 4%, 3.5% growth next year with a reasonable degree of visibility, I suspect there's not going to be a real pressure on them to put too much more fiscal stimulus there. There isn't much we can do on the monetary side. Interest rates are probably just about as low as they can go. But if in real terms, interest rates are not that low. So you could even see a little bit further cuts there if we see a big correction. But I'm not expecting that at all. I think 3 to 4%, 3.5 to 4% growth will be the order of the day for next year.
All right, Peter, let's leave it there for the moment. Sneak in a quick break here and come back and talk to you in just a moment. Peter Churchhouse of Morgan Stanley's in our Hong Kong studio.